And we see again, Fed cut their rate. Mortgage rates kind of reflected the opposite, but that's because we know mortgage rates live on expectations more than what's happening in real time. With the government shutdown, ADP still has to come out with their figures to make sure Social Security gets paid and other factors that are tied into ADP and the check company. But their figures come out tomorrow, and it's supposed to be very, very weak. And here's an answer that you may not like, right? So we got like 20 loans in our pipeline right now, and that's huge. We got a big pipeline full of loans, and not a single one of them is a purchase.
I'm Karl Kish, your San Diego realtor, and we're back with Matt.Kish from Movement Mortgage, updating us on mortgage rates. Matt, thank you again for joining us. Can you just give us a quick update? Rates looks like they've been kind of settling, but with subtle adjustments, is that right?
Yeah, they're kind of settling again after the Fed decided to cut their rates. Interest rates again for our side of the tracks will tick back up. And so now it's that wait and see, and hopefully the dust settles and them coming back down to where they were prior to the cut. But just like the previous cut, right, where they bounced up about 3/8, here we are again. Bounced up about a quarter, not quite the 3/8 that we got back last month, but they did tick up about a quarter. That really, if you didn't have your pipeline set up the right way, could have affected a couple of your purchases if they weren't locked, or refinances, and had to kind of drag those out a couple weeks longer to really recoup what we did lose in the market.
So let's just recap that real quick, if you don't mind. We've had 2 cuts this year. We had 2 cuts last year. And is it the case, correct me if I'm wrong, 4 total over the last 2 years, and each time we've had rate cuts, mortgage rates went up. Obviously different degrees or to different extents, but in all 4 cases, mortgage rates have gone up. Is that correct?
Correct. Last year's was a different story. Obviously, there was the election, and then the BLS having their inflated jobs numbers for last September all the way through May of this year, right? The inverted yield curve. There was a lot of factors that really kicked up the rates even more so last year than they did this year. But again, like we've talked about over this last year, the Fed cutting their rate doesn't correlate always to the mortgage rates falling. And we see again, Fed cut their rate, mortgage rates kind of reflected the opposite. But that's because we know mortgage rates live on expectations more than what's happening in real time, right? So the expectations of the cut are why we got, decent rates leading up to the cut. And then when the cut happens, now we're gathering information for a whole new set of expectations, right? So it kind of follows suit, and hopefully everybody was prepared for it. We've been chatting it up and kind of letting people know, hey, this is kind of the trend that it's following. When the interest rates get cut by the Fed, the mortgage interest rates kind of get kicked to the curb a little bit, and we have to do some fighting to get back up.
So with that being the case, I think I looked at it over the weekend and I reported on it on my San Diego Market Matters. The CME Fed Watch tool, which is like a platform that takes in all the data, the futures and everything like that, and predicts what's the likelihood of the next Fed rate cut. Before the last one, and before Jerome Powell, head chair, spoke, I believe a second rate cut in December was like 94 or 90. It was like a 90-something% chance that a second rate cut would happen. After the talk and everything like that, which Jerome Powell came out and said, we're gonna wait for more data, very typical of Jerome Powell. The chances dropped to, I think I saw 66-67% over the weekend. So with that being said, what I'm wondering is, if someone is looking to buy, it's probably in their best interest to talk to you before the rate cuts, right? Since they're kind of tricking up just a little.
Absolutely. Like, the whole point of the conversation anytime is to get the game plan. What's the game plan when, in the time frame that we're talking about, right? So if you're calling me today, yeah, that's going to be part of our conversations. Like, hey, upcoming, there might be some information coming out from the Fed that kind of triggers mortgage rates in a different direction, right? We definitely have to have these conversations, and it definitely has to be part of our game plan moving forward, because any information, especially right now with the government shutdown, there's not a lot of information to be had. So any information we could share, any strategy we could really make, good going forward and keep us on the track is what we want to do, and basically why we're here. We want to make sure people are informed and educated on the best strategy for them and their financial futures going forward.
Boom. Okay, so you guys hear that. Do not wait for the Fed rate cut to come down. Talk to Kish first, get the game plan, get the assessment, understand how these Fed rate cuts are going to affect your mortgage rates and how over the last 4 of them, they're not affecting them in a positive way right away. So, okay, let's move on to the next question. So the 10-year Treasury is not exactly the influential factor, like a direct influential factor on mortgage rates, but mortgage rates tend to follow the 10-year Treasury. And our last call, or our last video, I should say, the 10-year Treasury bounced just below 4%, which is like something we've been trying to get to. And so I think October it bounced below 4% 2 or 3 times, but just for a skip, which you talked about in the last video. You're like, it gets down there and it lasts for like 2 days or something, or 3 days. So we see the 10-year Treasury adjusting, but we're not really seeing mortgage rates adjust with it as much. They're kind of just stalling, with the exception of the Fed rate cut bumping it up a little bit. Mortgage rates they're sticky. Can you give us any insight on like what's going on with the bond market and in relation to the mortgage rates?
We're right there. We're still right there. We bounced off the 4% and we jacked up. Now we're right around 4.1% as we talk today. Definitely getting a little better today. Should be getting better with a little more information coming back out really soon with ADP, right? So that right now is kind of our gauge, the new BLS report, if you will, with the government shutdown. ADP still has to come out with their figures to make sure Social Security gets paid and other factors that are tied into ADP and the check company. But their figures come out tomorrow, and it's supposed to be very, very weak, right? So that's going to help our side of things, right? When there's weak job reports, mortgage rates usually tend to get a little bit more positive. But again, that's kind of a wait and see. Is that job report going to be, how weak is it going to be? Because without any real information, nobody really knows. We just heard, hey, the numbers probably aren't going to be very good.
Yeah, the whole labor data situation is a bit of a conundrum with the government shutdown right now. Thankfully, we do have ADP to provide us with some data to help the markets a little bit. Let's go ahead and move on to the next question. So if we look at mortgage applications, that's what I'd like to talk about next. If we go back to about, I think it's mid-September, we started seeing this peak and this drop off in mortgage applications, new mortgage applications. And this is very typical during the season. Buyers aren't rushing to get qualified right around the holidays. So it makes sense. This is very seasonal. This is very expected. And so what's really interesting though is at the end of October, we saw a very, very significant bump up. Just very, very random, very unexpected. My gut tells me it's an outlier. It's just like a one-off. There wasn't anything that was significantly different in mortgage rates in the month of October that would spark interest. What I'd like to hear is if you can fill us in on what you're experiencing with buyer sentiment and buyer engagement in your guys' office with regards to are buyers just sitting on the fence? Are they held up with other hurdles in the way? Are rates low enough that it is sparking enough interest, enough financial like enhancement to their financial capability to buy? Is any of this happening, or how is it happening from your experience?
That's a great question, Karl. And here's an answer that you may not like, right? So we got like 20 loans in our pipeline right now, and that's huge. We got a big pipeline full of loans, and not a single one of them is a purchase, right? So the uptick in these applications might have been refi based, at least for us, right? We're still having these conversations for buyers and sellers and purchasing and everything involved in buying a home every day. Still talking to first-time home buyers, still talking to veterans, still talking to active duty members, still talking to people about getting them into a home every day. But as far as them applying and as far as them really searching out the affordability, man, that's definitely fallen off a cliff. I would say people sitting on the sidelines is now more prevalent than ever because we have seen these interest rates come down almost a percent or more in a lot of cases. Man, these VA loans, these FHA loans, I mean, a cash out FHA refinance on a condo, we're still in the mid fives on a cash out condo, right? On FHA. So when you a lot of people were waiting for rates to come down. We're there, right? So what is it now? So what is the what? What is the why? What is your why for sitting on the sidelines? And I still think a huge part of it is affordability. We're seeing a lot of things in the grocery stores, in retail stores, in everyday life, gas. Those prices haven't come down at all, even though promises of have been really high. We're still feeling it, and we've been hitting this topic a lot. Is credit card debt is still right now, as of Q2 of 2025, $1.2 trillion in household credit card debt. That's crazy. That's just astronomically not a good spot for this country to be in if you want to buy a home, right? If everybody's tied up with debt and affordability, and groceries are high, the big ticket items are definitely going to take a back seat to everyday life. So the houses, the ADUs, the boats, the RVs, you're going to really see a tightening on all of those markets. And that's where we're at. When we saw this big influx, I can't speak for the nation, I can't speak for the lender down the street, but our big influx in applications were refinances. And again, here we are, I was talking about FHA cash out. That's to refinance debt. I have a borrower who's like, hey, like, I know FHA isn't what I want, the loan I want to be in permanently, but it's going to really help me out eliminating my credit card debt, eliminating my student debt, paying off my car, so that I'm completely liquid and my only monthly payment is going to be my mortgage, and I'm saving almost $1,000 a month in debt payment, right? So that's where we're at right now. There's people that are trying to get themselves out of debt and using their equity to do so.
Wow, this is so crazy. And this is such a powerful insight. So you have 20 loans in the hopper, all of them are refis. If you are a seller watching this video, okay, this actually tells us two things. One, if you're a seller watching this video, and let's say your sub maybe 800,000, the entry level market, the buyers aren't there, okay? Like we're just really shallow on the buyers. Now, as Kish said, he's not speaking for the nation, but that's why we bring him on this video every other week for you guys, so you understand, you get updated with what's happening in our local market. He's saying right now that they're not coming across very many buyers that are looking to buy. So understand that the buyer pool out there is super shallow. Now, in addition, the second thing that this means is that because there's not that many buyers out there, if you are a buyer, you're probably not going to be competing with a lot of multiple offers. Circling back to the bond market that we talked about in the first question, it seems like the bond market, we know that the bond market is like kind of always ahead of the Fed. And with Jerome Powell's, the Federal Reserve's recent rate cut, and even the one, the recent one, let's just say that one. And then the talk he had after he did the rate cut, we saw mortgage rates adjust, but I'm just wondering how much control does the Fed really have right now, being the fact that we have a lack of data, they're raising rates. It just seems like the mortgage rates and the bonds market is being reactive to so many other things going on. Can you give us any insight as to what's really driving this? Like how much control the Fed really has on mortgage rates right now?
Boy, $1 million question, Karl. They still have good control. I mean, if they were to cut a significant amount, you would see other markets react, right? So the Fed still has a big bunch of control. But the good part about the Fed and them kind of being an independent entity is they're not out there wielding it, right? Like, yeah, the country would be helped but what would the repercussions of that be economically, right? If the Fed was just cut their rate 1% right now, there would be a great deal of good come from that. But what are the cons, right? What are the cons of that? And there's a lot of politicians out there that are really pushing for the Fed to lower rates, not thinking about the cons, not thinking about the already $39 trillion this country is in debt, right? Not thinking about the $1.2 trillion we are in credit card debt, $17.8 trillion in household debt. Again, everybody's looking for the quick fix. Fortunately for us, the Fed isn't really taking the bait, and they're kind of just mellow right now. As we've seen, even with these rate cuts, from the Fed, and the hit to the bond market and the hit to the mortgage interest rates, they weren't very significant, and we've kind of already bounced back from both. So I really think, and like we talked about previously, this is kind of where we're living until we know what we're doing with policy. We still don't have any policy, not on healthcare, not on economics, not on immigration, not on anything, but there's really just no policy. So the Fed is just kind of taking the factors that they can, ADP, world markets, it's election coming up, right? So these elections may have a little sway of the pendulum as far as these markets are concerned, depending on who wins and where. So right now, the Fed is kind of handcuffed to the bed. They can't move. They can't really go anywhere. They're somewhat comfortable because they got a bed to lay on, but they're handcuffed to it. They can't really do a whole heck of a lot given the information that's out there.
Gotcha. Well, thanks for continuing to show up with us, giving us the update on what's going on in the mortgage market, not just nationally, but also here in our own backyard here in San Diego. If you have any thoughts, questions, or concerns, reach out to Kish directly. I have his contact info in the description below. And also, we have a really, really great video probably coming out next week in regards to a new loan program, a buyer assistance program that we're going to talk about in another video. Again, it'll drop next week, so stay tuned. Be sure to like and subscribe so you can catch that and be on the front of the seats watching that video so you know how to get into it. Any thoughts, questions, concerns, don't hesitate to reach out. As always, I'm Karl Kyler, your San Diego realtor. We'll see you in the next video.